You're listening to The Credit Edge. What could go wrong? And are you compensated for that risk? That's the question we explore through credit markets, cycles, and portfolio construction.
You know, most of us, and I'm talking probably almost everyone listening right now, we operate within a very standard financial playbook. It's almost like an institutional conveyor belt, really. Mm-hmm. You open the 401k, you try to max out the Roth IRA, you save diligently, diversify across index funds, and you rely on advisors who, mostly tell you to stay the course.
Right. That's the conventional wisdom.
And look, it's not necessarily bad advice. It's solid for building modest wealth over time. But the source material we're digging into today suggests this whole approach is, fundamentally incomplete.
Yeah, there's a huge piece missing.
A massive missing piece, like a structural secret that apparently sophisticated investors, big institutions, they've known about and used for centuries.
That's exactly it. And our mission today really is to unpack that secret.
Yeah.
To understand the fundamental difference it makes when you position yourself as a creditor versus being a debtor.
Okay. Yeah.
So this deep dive, it isn't about picking the next hot stock, or trying to guess where the market's headed next quarter. Not at all.
No.
It's purely about the structural choice.
Yeah.
Where do you put yourself on the balance sheet of the economy? Because that choice, as the sources lay out, it radically changes your long-term financial path.
How you experience market chaos too, presumably.
Absolutely. It dictates that.
Right.
And maybe most importantly, it determines when or even if you truly get control over your own time.
Okay, let's get into this with what the source calls the 4,000-year constant. That's a pretty bold claim right off the bat.
It is. Incredibly powerful, almost intimidating.
Yeah, the assertion is that for the last 4 millennia, think about that. From ancient Babylon, Mesopotamian debts on clay tablets, all the way to today's high-frequency trading floors on Wall Street. Wealth has flowed consistently, relentlessly, in just one direction.
From borrower to lender.
From those who borrow money to those who lend it, always.
And it's that consistency that always that really grabs you, right? That's what makes it a constant, not just some cycle or trend we're seeing lately.
Yeah.
This flow, it's apparently outlasted monarchies, revolutions, empires collapsing, every technological leap you can imagine. The source really emphasizes this isn't rooted in some fleeting economic theory.
No, it's math and human nature.
Exactly. Immutable laws of mathematics, like compound interest working relentlessly, and, basic human nature, our tendency towards consumption, maybe short-term thinking.
I just want to sit with that for a second. 4,000 years. That implies the basic engine driving how capital accumulates hasn't fundamentally changed since the Bronze Age.
Pretty much. It's the simple, relentless power of an interest.
So if you're always on the paying side of that equation, the debtor, that flow, is fundamentally working against you. It's constantly eroding your savings, your future buying power.
And conversely, if you can somehow position yourself on the receiving side, become the creditor,
right,
that exact same relentless mathematical force starts working for you, 247, year after year.
It's like a physical law of finance almost, like gravity.
That's a great way to put it. You can build up wealth on paper in the stock market, sure.
Yeah.
But if you're doing that while you're structurally indebted elsewhere in your life, you're fighting gravity the whole time.
Which brings us right back to the listener. If you're out there and you're doing all the right things, saving, indexing, diversifying, but you still feel like building truly lasting wealth that gives you real autonomy, if that feels incredibly hard, almost out of reach, then maybe this exploration offers an explanation, a structural one. Perhaps the problem isn't just how much you save. Maybe it's the inherent conflict in the structural position you're occupying while you save.
And that raises a really critical question the sources touch on. If this pattern, this flow, has held for 4,000 years, why is the conventional financial advice, the playbook handed out everywhere, mass media, much of the financial industry, why is it still centered almost entirely on encouraging people to accumulate assets primarily as debtors?
Right. It encourages borrowing for houses, leveraging for cars, sometimes consumption.
And passively waiting for capital gains in the market, while almost completely ignoring the vast available world of lending, of being the creditor.
That's the deep tension, isn't it? And we're going to explore it using the story the source provides, this tale of two brothers. It's a really effective way to illustrate this fundamental choice we all face. Okay, so the tale of two brothers. The crucial point right at the start is that the difference between them isn't about luck. It's not who was smarter or who got a better job.
No, none of that. It's purely about a strategic foundational decision. How did they structure their financial lives? That's it.
The source uses this to show the contrast. Brother 1 follows that institutional conveyor belt we talked about,
The default path. Doing everything he's told.
while Brother 2, he focuses on mastering the financial structure.
Exactly. Structure over just accumulation. Brother 1's structure, it puts him permanently in the seat paying interest. He's always beholden to the lenders, the institutions.
Whereas Brother 2, through deliberate choices, often kind of boring choices maybe,
Often very boring choices, yes. He positions himself to be in the seat receiving interest. The difference isn't the total dollars saved at the end, necessarily. It's which side of that 4,000-year wealth flow they chose to occupy.
Okay, let's dive into Brother 1 first. The conventional debtor. He's the archetype, right? The picture of middle-class financial responsibility you see everywhere.
He really is. His approach is exactly what you're told to do. Works incredibly hard, gets promotions, saves diligently, mostly in the 401k.
Invests in standard mutual funds, index funds.
Right, the usual suspects. And he trusts his advisor. Diversify broadly, stay the course. He genuinely believes he's doing everything right, following the path laid out for him.
But structurally, when you look at his position, the reality is quite different. He's defined by being a debtor. Let's break down where the money flows away from him.
Okay, first, the big one. A significant 30-year mortgage on his house. The largest debt most people ever take on.
Check.
Then, car payments. He's consistently taking out auto loans, or, maybe more likely these days, leasing new cars. Refreshing that debt every few years.
Right, paying for depreciation.
And often, there's some occasional credit card debt. Maybe he rotates balances, uses 0% offers for a bit. But ultimately, he's paying that interest cost.
So consistently, year in, year out, he's paying out significant amounts in interest, loan fees, administrative charges.
All flowing to the institutional creditors. He is the customer in the wealth equation. He's the one providing the reliable cash flow to the banks, the finance companies, the credit card issuers.
And the outcome described for him in the source, it's quite poignant. After decades of doing everything right, sacrificing, saving, he retires with enough money to survive.
But the wording is specific.
Yeah.
Definitely not enough to relax.
Right. His wealth is like this single large pool of water that he has to carefully guard, not a flowing stream replenishing itself.
And then the inevitable market crash hits. We'll get into the details of that later, but boom, portfolio collapses in value.
The psychological pain is too much.
He panics, sells at the worst possible time, locks in those devastating losses, and spends years just trying to claw back to where he was.
He's perpetually vulnerable, really, because his entire life structure is built around making payments outward.
To the bank, the car dealership, the credit card company, not receiving them. His financial life is structurally upside down.
Okay, now let's contrast that with Brother 2, the strategic creditor. His approach is fundamentally different. Why? Because he recognized that relentless flow of wealth you mentioned.
He saw it, and he learned to position himself differently by owning debt rather than being owned by it.
And this is where we need to get specific, right? The source isn't talking about him becoming some kind of private loan shark.
No, absolutely not. This is crucial. The source material is very clear. These are investment vehicles available to everyday retail investors. You or me, anyone.
But they're often overlooked or ignored in the standard advice.
Actively overlooked or ignored in the conventional growth-focused playbook, yes. Because they don't fit the narrative of chasing capital gains.
Okay, let's detail these specific credit instruments. The things that make up Brother 2's portfolio. These are assets that are basically loans or have fixed, legally obligated income streams tied to them. We're not talking about volatile tech stocks here.
Not at all. Think about, say, mortgage-backed securities, MBS. Sounds complicated, maybe a bit scary after 2008.
Right.
But fundamentally, it's just pools of residential mortgages. Brother 1 has a mortgage payment going out. Brother 2 buys the security backed by thousands of similar mortgages. He effectively becomes the lender.
Receiving the principal and interest payments that people like Brother 1 are sending out each month.
Exactly. Then you have straightforward corporate bonds. Loans to established companies. The company issues a bond, promises to pay fixed interest rate, the coupon, for a set period. Brother 2 provides capital to the corporation, gets fixed payments back.
Makes sense.
And, critically important, senior loans, sometimes called leveraged loans. These are loans to companies, often companies with significant debt already. But crucially, these loans sit at the top of the company's capital structure.
Meaning they get paid first if things go wrong.
Precisely. If the company hits trouble, even bankruptcy. The senior loan holders get paid back first. Often they're secured by specific collateral before common stockholders or even some lower-ranked bondholders see a dime. That seniority provides a significant layer of security.
Okay, what else?
Asset-backed securities, ABS. Similar concept. But the debt is based on things like credit card receivables, auto loans, equipment leases. Again, Brother 2 is positioning himself to collect the payments that other debtors are making on their cars, their machinery, their credit card balances.
He's systematically harvesting the interest payments from the debtor economy.
You could put it that way.
Yeah.
And don't forget the hybrids, particularly preferred shares. These act a bit like a stock and a bit like a bond.
How so?
They represent equity ownership, technically, but they pay a fixed, or sometimes floating, distribution payment before any dividends can be paid to common stockholders. If a company decides to pay out anything to shareholders, the preferred holders get their stated amount first. Priority again.
Got it. And finally, the source highlights a specific structure: business development companies, BDCs.
Yes, BDCs. These are quite interesting. They offer a way for regular investors to essentially become lenders to middle market companies.
Companies that might be too small for traditional bank loans or public bond markets?
Often, yes. Privately held, growing companies. BDCs primarily invest in their debt or equity.
And what's unique about their structure?
Regulation forces them, generally, to distribute at least 90% of their taxable income to shareholders as dividends. This structure basically compels them to be high-yield vehicles. The interest payments they receive from the companies they lend to flow through fairly directly as high distributions to the BDC shareholders, like Brother 2.
So all these instruments, MBS, corporate bonds, senior loans, ABS, preferreds, BDCs, they might seem different, but they share one vital structural characteristic.
They absolutely do. They are all vehicles that let Brother 2 earn interest, structured as legally binding payments. They place him firmly, structurally, in the creditor's seat.
Okay, so his position is that of the lender-creditor, systematic.
Precisely.
Yeah.
And when the market crashes, as it inevitably does, that income stream, the contractual obligation for borrowers to pay interest, often continues flowing. Maybe not perfectly, but it's buffered by the legal structure, the seniority, the collateral.
And the outcome, which we'll get into the numbers now, is that compound interest works for him, building not just paper net worth, but a substantial, reliable stream of income and cash flow.
That's the fundamental divergence.
So the core takeaway here is structure. The difference in their financial lives wasn't luck, wasn't smarts, it was the strategic choice. Debtor side, waiting on sentiment, or creditor side, relying on contracts. Okay, this is where the conventional way we measure financial success, the way most advisors talk, really starts to fall apart, according to the source. Because if you just look at the big number, the net worth, Brother 1 actually looks like he won.
Right. And this forces us to question, what does winning even mean in finance? The source says, over 30 years, Brother 1 hits an $800,000 net worth. Brother 2, who prioritized income, only reaches $600,000.
So Brother 1 is ahead by $200,000 on that metric. His advisor probably pats him on the back every year.
Absolutely. Look at that growth. But this highlights that fundamental confusion, focusing purely on accumulation, the size of the pile, instead of generation, the cash flow coming out the pile, and the autonomy that provides.
Let's dig into Brother 1's outcome more deeply. The source calls it the countdown clock. That sounds ominous.
It is, and for good reason. His $800,000 net worth, while it looks impressive on a statement, only generates about $12,000 a year in actual income.
Wow, only $12,000. That's a yield of just 1.5% on his capital.
Exactly. And listen, that's not some made-up low number for effect. That 1.5% yield is incredibly typical for retirement portfolios built the conventional way, focusing on growth stocks and broad indexes.
Why is it structurally so low? Let's break down that $800 K portfolio again. Where is it invested?
We have to. His 401k is likely stuffed with growth stocks, right? Companies focused on expansion, reinvesting profits, not paying big dividends. So minimal income there.
Okay.
His taxable accounts, probably broad market index funds. Again, diversified, yes, but heavily weighted towards tech and other low dividend growth sectors. Maybe you get a 1%, 1.5% dividend yield from the S&P 500 index, something like that.
And the big one, a huge chunk of that $800,000 net worth is probably tied up in his house. Home equity.
Precisely. Let's say $300,000 of that $800K is equity in his primary residence.
Yeah.
That boosts his net worth number significantly.
But it generates zero income.
Zero cash flow.
Yeah.
It's functionally idle capital from an income perspective. It's not paying the bills. So a huge slice of his accumulated wealth is paralyzed when it comes to actually sustaining his lifestyle in retirement.
So let's say brother one was earning $85,000 a year before retirement. That $12,000 in portfolio income, even if you add Social Security, it's just not going to cut it. It can't replace his paycheck or cover his expenses.
Not even close. The $800,000 number is a great talking point, but functionally, as an income generator, it's insufficient. So the moment he retires, age 65 perhaps, he must start selling off the principal. That $800 case starts shrinking from day one.
That's the countdown clock.
That's the countdown clock. Every withdrawal is one step closer to zero. His future is tied to spreadsheets, life expectancy tables, and hoping the market doesn't tank right when he needs the money most.
That is a really stark, almost, painful contrast to brother two's outcome, which the source frames entirely around cash flow and time autonomy.
Completely different picture. Brother two has the lower net worth, remember, $600,000. But his cash flow tells the real story. That $600 K generates $54,000 per year in distributions.
$54,000. Okay, wait, that's a 9% yield on his capital?
A 9% yield. Orders of magnitude different from brother one's 1.5%.
And his portfolio, how is it built to achieve that? It's those income-focused debt instruments we listed earlier.
Exactly. Constructed entirely from diversified credit instruments. Senior loan funds, BDCs, preferred shares, maybe some well-chosen corporate bonds. For him, every month, every quarter, reliable income arrives in his account.
He doesn't need to sell shares to pay for groceries.
He doesn't need to hope the market goes up so he can afford his property taxes. He receives legally obligated income based on contracts.
And the functional relevance for someone listening, this is huge. That $54,000 cash flow is enough, or close enough, to cover his basic living costs.
It likely covers his baseline expenses, yes.
Yeah.
And because he achieved that, covering basic needs with passive contractual income, the source tells us he stopped working full-time at age 58.
7 years earlier than his brother who had the higher net worth.
That's 7-year difference. And more importantly, the shift from having to work to choosing whether to work. That is the real prize, not the bigger number on the statement. It's time autonomy.
He got financial independence not by having the biggest pile, but by building the most efficient, resilient, contractual income stream from a smaller pile.
Precisely. Structure trumped accumulation.
Okay, wait. I have to push back here because that 9% yield figure, that's the point where the conventional mindset screams too good to be true, or that must be incredibly risky. How is 9% achievable when 1.5% is typical? Is this only for hedge funds or something? Defend this based on the source?
Yeah, this is absolutely the core tension. It's what separates the structural thinkers from the pure accumulators.
Yeah.
Brother one, the conventional investor, is invested in growth assets. His return depends primarily on capital appreciation.
Hoping the stock price goes up.
Hoping the market values his shares higher tomorrow than today. That appreciation is volatile, it's unpredictable, and the income component, as we saw, is tiny.
Okay, and brother two, how does he get 9% without relying on that hope?
Brother two invests in credit instruments. His return comes primarily from contractual interest payments, coupons on bonds, distributions from loan funds, fixed payments based on legal agreements.
Legal obligations.
Legally bound obligations. A company that issues a bond or takes out a senior loan held by a fund brother two owns, that company is obligated by law to pay the interest, regardless of whether its own stock price is up 50% or down 50% that year. It's that contractual senior priority income stream that structurally drives the higher potential yield.
But the standard warning is higher yield equals higher risk. What specific risks is brother two taking on to get that 9% that brother one isn't? How is that justified?
That's the critical trade-off, and you have to understand it. Brother one primarily takes on market risk, broad, undifferentiated risk that market sentiment turns sour, a recession hits, and the value of all his growth assets plummets.
Okay.
Brother two swaps much of that market risk for credit risk, the specific risk that the individual borrowers whose debt he holds through funds, BDCs, etc., might default, that they might fail to make their scheduled payments. The market compensates brother two with that higher yield specifically for taking on that defined, measurable credit risk.
So the 9% isn't magic money. It's the market's required compensation for the risk of lending to, say, middle market companies via BDCs, or holding asset-backed securities, or owning corporate bonds that aren't risk-free treasuries.
Exactly right. And the author's crucial point here, again, is that this compensation, this yield, is not reserved for the ultra-elite or institutions only. These instruments diversified senior loan funds, BDCs, preferred ETFs. They are available to any retail investor on major exchanges.
So the gap isn't access, it's awareness, discipline.
It's awareness of the structural choice, and maybe the discipline to stick with an income strategy even when growth stocks are soaring. The conventional playbook steers almost everyone towards growth and appreciation, making them debtors in their personal lives, mortgage, car loan, and passive speculators in their portfolios,
while ignoring the readily available structured lending vehicles that would let them become systematic creditors instead.
Precisely. That structural positioning, it dictates not just when you retire, but how you emotionally and financially survive the crises that inevitably come along. Which brings us to the stress test.
Right. The true test of any financial strategy isn't how it performs in a bull market. It's what happens when the floor gives way, when fear dominates. The source paints these two incredibly different pictures of how the brothers react during a major market crash. Let's start with brother one, the debtor. He faces an existential crisis.
Yeah, when the crash hits, for him, the financial impact is just total, devastating. His 401k, his main wealth engine, is down 40%, maybe more. Those growth stocks, index funds, their paper value has collapsed.
And at the same time, the value of his house has likely plummeted too. So his home equity, maybe his biggest single asset on paper, has evaporated or shrunk dramatically.
Exactly. But here's the kicker. His outflows haven't stopped. The mortgage payment is still due every month. The car payment still needs to be made. The credit card interest keeps accruing. The payments going out are relentless.
While the value of the assets meant to support his future has cratered, the psychological pressure must be immense.
The source describes it vividly. Obsessive checking of his portfolio value multiple times a day. Severe sleeplessness. The pain is unbearable. And why? Because his entire sense of future security was tied to that principal value.
The number on the screen.
The number on the screen. When that number drops 40%, it feels like 40% of his future, his retirement, his security has just vanished into thin air. Plus, he's likely worried about his job security in a crash environment. His future feels completely conditional, utterly vulnerable.
And what does this unbearable psychological pain almost always lead to?
The classic tragic mistake. He sells near the bottom. He capitulates. He can't take the pain anymore, so he converts temporary paper losses into permanent real losses.
Locking in damage that could take a decade or more to repair.
If he ever fully repairs it. The crucial insight here is that his wealth was entirely dependent on sentiment, on what other people thought his assets were worth at that moment. When that collective sentiment vanished in the panic, his ability to execute his long-term plan just disintegrated. He was forced into reacting, and he reacted badly. He became a casualty of his own structure.
Okay. Now, contrast that visceral, gut-wrenching experience with brother two, the creditor. His experience during the same crash is framed totally differently, not as a crisis, but as an opportunity.
It's a fundamentally different experience. Let's be very clear. Brother 2 sees the crash too. Volatility absolutely affects him. The market price of his holdings drops, corporate bonds trade down, preferred share prices get hammered, the net asset value, NAV, of his closed-end loan funds might fall, and they might trade at wider discounts to that NAV. He's not immune to paper losses.
But, and this is the key difference.
The key difference. The distributions keep arriving. The income stream acts as a psychological and financial buffer.
Because it's contractual.
Because it's contractual. The senior loan fund he owns is still receiving mandated interest payments from most of its underlying corporate borrowers, so it still pays out its monthly distribution, perhaps slightly reduced, but it likely continues. The BDC, structurally required to pay out most of its income, still sends its quarterly distribution. The preferred shares still deliver their fixed coupon payments because they have priority. The cash flow doesn't just evaporate because the stock market is panicking or because the trading price of the bonds or funds has fallen.
Which means, crucially, he doesn't have to sell his principal assets when they are down 30% or 40% just to pay his living expenses.
He absolutely does not need to sell the principal out of desperation. He needs the income to live on, and the income, while potentially stressed in a severe crisis, is structurally far more resilient because of the legal priority, the collateral, the diversification within his funds.
And even more profoundly, because he still has this steady stream of cash coming in. What can he do?
He can act counter-cyclically. He could be strategic when everyone else is panicking. He uses those incoming distributions, that $54,000 a year, to buy more income-producing assets at distressed fire sale prices.
So when that BDC that was trading at $10 before the crash is now trading at $6, but it's still paying out, say, $0.80 a year in distributions, His incoming cash buys him significantly more future income potential at that lower price.
That is the compounding advantage of the creditor structure in a crisis. When the market eventually stabilizes and recovers, Brother 2 emerges owning a much larger quantity of these income-producing assets than he did before the crash. His future income stream is now potentially even larger. His financial security wasn't tied to the fickle sentiment reflected in a volatile screen price. It was tied to a stream of contractually obligated payments.
Okay, let me play devil's advocate again, because the source itself rightly includes caveats. This sounds great, but isn't it just swapping one risk for another? Instead of market risk, isn't Brother 2 taking on potentially catastrophic default risk? If the economy really tanks, surely those contractual payments on senior loans, BDC investments, even corporate bonds, surely they face a massive risk of default. Loans get restructured, distributions get cut or suspended entirely. Why should we believe credit is fundamentally safer? Look at 2008.
That's absolutely the right question to ask. And the source material does not claim this is a risk-free strategy. It explicitly acknowledges that in severe recessions like 2008, credit markets can freeze. Debtors do default. Contractual does not mean guaranteed payment under all circumstances. Distributions can be, and sometimes are, cut. Bond prices can crater temporarily.
So what's the crucial distinction then? Why does Brother 2 still arguably maintain superior resilience and strategic positioning, even acknowledging that default risk?
The distinction lies in the nature and the manageability of the risk and the compensation for it. Brother 1, remember, takes on broad, undifferentiated market risk. If the S&P 500 falls 40%, his portfolio falls 40%. There's no specific collateral, no priority structure protecting him. His only hope is the market coming back.
Which feels abstract and uncontrollable.
Very. Brother 2, on the other hand, takes on specific, quantifiable credit risk. And critically, he can mitigate this risk through several structural elements inherent in the credit world, which are less available to the common equity holder.
Okay, what are those? First, diversification, presumably.
Correct. Brother 2 isn't lending his life savings to one single company. He's invested through funds, ETFs, CEFs, mutual funds, or BDCs that hold loans or bonds from hundreds, maybe thousands, of different borrowers across various industries. The default of a few borrowers won't destroy his entire income stream.
Makes sense. Second,
seniority and security. As we discussed, Brother 2 often prioritizes investments in senior debt, frequently secured by specific company assets, collateral. If a borrower defaults, there's a recovery process. Collateral gets sold, and the senior lenders are first in line to get paid back, often recovering a significant portion of their principal, unlike the common stockholder, who usually gets wiped out.
So even in default, the loss isn't necessarily 100%.
Often far from it for senior secured debt. And the third element, perhaps the most important conceptually,
The compensation.
the compensation. Brother 2 receives that higher yield, the 9% in our example, precisely because he is consciously accepting and underwriting that specific, measurable risk of default. His $54,000 annual income is his payment for bearing that risk.
So when the crash hits, Brother 1 panics because his problem feels existential. Will the market ever come back enough for me to retire?
An abstract, sentiment-driven fear.
Whereas Brother 2's concern is more concrete, more manageable. Okay, will the default rate in my diversified portfolio of collateralized loans exceed the historical average I was compensated for? How much might my income dip temporarily?
Exactly. The latter is a financial analysis problem, potentially solvable with adjustments. The former is an emotional crisis driven by dependence on market sentiment. The difference, again, comes down to the underlying structure.
This has been a really deep dive into the comparison. We've gone from the 4,000-year historical pattern through the starkly different numerical outcomes and landed on the profound psychological distinction during a crisis. Let's try to synthesize the absolute core difference that separates these two paths.
I think it boils down to control, expectation, and the direction of payments. Brother 1's financial future was perpetually hostage to market sentiment. He was fundamentally reliant on the collective optimism, sometimes irrationality of others, to bid up the price of his assets so he could eventually sell them.
A hope-based strategy, essentially.
Largely, yes. Hope for appreciation. Brother 2's future, conversely, was contractual. It was secured primarily by legally enforceable obligations contracts stating that specific amounts of money were owed to him on specific schedules. That fundamental difference dictates whether you react to a crisis with panic selling or with strategic reinvestment.
And this brings us right back to that central revelation from the source material. Building wealth isn't just about accumulation. It's not just saving more, working harder, or even just diversifying in the conventional sense. It is fundamentally about structure.
Yes. The structure you choose dictates the flow of money. That flow determines your cash flow. And that cash flow ultimately determines your level of time autonomy. This focus on the balance sheet structure, are you primarily a creditor or a debtor? That's the piece that conventional playbook almost entirely ignores.
Why? Why is the standard advice, the playbook handed out by so many institutions, so obsessively focused on accumulation and appreciation, save more, put it in index funds, that it effectively neglects this crucial structural question of payment flows?
Well, one perspective offered implicitly by the source is to consider who benefits from the conventional structure. That playbook positions the average investor primarily as a passive common equity holder. That's the riskiest position in a company's capital structure, the last to get paid.
Okay.
And simultaneously, by encouraging long-term mortgages, auto loans, consumer debt, it places that same individual firmly on the debtor side of their personal balance sheet. This dual positioning, it almost guarantees the individual is perpetually paying interest outwards to institutional creditors,
While passively waiting for uncertain capital gains from the riskiest part of the capital structure inward.
It's a structure that generates immense reliable cash flow for the financial institutions acting as the creditors and asset managers.
So let's reiterate that key insight because it feels central. The conventional playbook is fundamentally incomplete because it sidesteps, perhaps deliberately, the structural question. Are you positioning yourself primarily to receive payments, or are you positioning yourself primarily to make payments?
Absolutely. The standard advice often leads you to believe the path is just about maximizing that volatile net worth number. But doing so often locks you into a structure where you're constantly making payments out to the bank, the finance company, the government, via property taxes on non-income producing equity, while waiting passively for appreciation from the market.
Whereas the structural solution, the path Brother 2 took, involves actively re-engineering your personal balance sheet.
Consciously deciding, so that you become the recipient of fixed, legally bound payments coming in from institutions and corporations, while simultaneously working aggressively to minimize your own personal interest-bearing debts going out.
As we start to wrap up this deep dive, I really want to pose that direct question the source material implies for everyone listening, and maybe take a moment to reflect on it. Which side have you primarily been on so far in your financial life? Have you mostly been the recipient of contractual, predictable payments coming in? Or have you mostly been the one making those kinds of payments out? And critically, was the position you find yourself in arrived at through a conscious structural choice? Or was it more by default, simply by following the conventional institutional path laid out for most people?
And reflecting on that leads to the final institutional implication the source raises. We should ask, who truly benefits most when the vast majority of people are steered towards the debtor side of the equation personally and the passive equity holder side in their investments?
Relying on uncertain capital appreciation.
Exactly. When billions of individuals are positioned structurally to make regular payments rather than receive them, that 4,000-year flow of wealth from borrower to lender, it doesn't just continue, it gets massively amplified. It flows towards the large institutional creditor complex. They benefit enormously from the current default structure. The structure benefits those who design it and sit at the receiving end.
Okay, let's do a quick recap of the core structural takeaways from this deep dive comparing the creditor versus the debtor position.
First, recognizing that 4,000-year constant. Wealth does consistently flow from borrowers to lenders. It's a pattern rooted in math, in legal structure, in priority, not just temporary market sentiment.
Second, the absolutely critical distinction between mere accumulation and true autonomy. The real goal isn't just hitting the highest possible net worth number on paper. It's about building a functional, resilient cash flow stream that can actually replace your paycheck and grant you control over your time much sooner.
Achieving time autonomy, right?
Right.
The freedom to stop trading your hours for money.
And third, the immense psychological resilience that comes from relying on secure, legally bound income streams rather than just volatile principal values. During a market crash, when others are gripped by panic, watching their net worth evaporate,
your income keeps arriving, or is far more resilient, and that transforms a potential existential crisis into potentially a calculated buying opportunity. It's a difference between being hostage to sentiment and being secured by contracts.
We established that building lasting wealth seems to be much more about conscious structure than just passive accumulation, We highlighted that stark difference between wealth based on sentiment, essentially, hope versus wealth based on contracts, legal obligations.
Which leaves us, and hopefully you, with a very specific, powerful, and practical question to think about moving forward. If your goal isn't just to survive retirement someday, but to achieve genuine autonomy, resilience, and control much earlier, how do you systematically assess and then re-engineer your own financial balance sheet?
How do you make that shift?
How do you move deliberately from primarily being in a debtor position to primarily being in a creditor position? It means shifting your portfolio's focus, perhaps significantly, away from just hoping for volatile capital appreciation towards actively securing those more predictable, often higher-yielding contractual payments through the kinds of structured credit instruments we talked about today.
BDCs, senior loans, preferreds, bonds.
Exactly. It requires a systematic, conscious, probably uncomfortable, but potentially transformative reevaluation of every single asset and liability you currently hold and asking, which side of the equation does this place me on?
Definitely something profound to consider next time you look at your financial statements. Thank you for joining us for this deep dive into structure over accumulation.
Until next time.
Thank you for listening to The Credit Edge. More frameworks on credit markets and income investing are available on Substack and YouTube. Perhaps I'm wrong, but the questions are worth asking. The Credit Edge is for educational purposes only, not investment advice.